What I want to do next is to get into the bonds chapter. And this chapter, although we're only spending one chapter on bonds, here again, base rate fallacy. More of you are going to work with bonds than with equities. Equities seem to be kind of the more fun, flashy asset to work with. But there's a heck of a lot more work to be done with bonds. Just think about it for a second. Bonds have a maturity date. They end at a certain point, and bonds durations change, and I need to keep a particular duration in my portfolio, so I'm always changing my bonds. A company typically has only one series of equity securities, but it might have dozens of different bonds issued at different periods with different risk, with different coupons, and so forth. So there's a lot more work to be done in bonds, and more of you will end up working with fixed income of some sort. I wish we could offer a fixed income class. We're not quite there yet. Still working on getting the resources in order to offer that sort of thing. So this is a taste of it, but please don't misinterpret the value and the importance of understanding bonds. So we're going to start off just with some of the basics, things that you probably already picked up in 312 or 521. Straight bonds are simply IOUs, and they are for a fixed sum of money that you'll get back at the maturity date. That's the principal, the par value, the face value, all synonyms for one another. And then during the period of the bond, while it's alive, you'll receive some sort of periodic interest payments. And this is to be differentiated from, say, an amortized loan, right? So if you buy a car or a house, that loan is going to have payments that are equal that you're going to pay every month or whatever the periodicity is. But those payments, if it's an amortized payment, are going to be both part interest and principal repayment. So at the end of the amortized loan, you will have not only paid all the interest, but you'll have also paid back all of the principal. A corporate bond is the coupon payments are interest-only payments, and the principal all gets paid back at the end of the bond. It's one thing. Make sure you keep that clear. Treasuries are an example. Treasury bonds are an example of a straight bond. Then we can add features. And here's just an example of a few of the features that we can add to the bond. We can make them convertible. So in other words, you could buy a bond, and at some point in the future, you could convert that bond into a specified number of shares of stock. Interesting concept. So this is like having a bond with an option embedded in it. And that option gives you the right but not obligation to use the value of the bond to buy stock. Now, the neat thing about this is that the value of the bond is usually $1,000. A corporate bond is typically $1,000 denominations for each bond. And the way that convertibility option is going to work, it's going to specify a number of shares that you can convert the bond into. So let's say the stock was selling at $30 per share, and you had a convertible bond with a face value of $1,000 and a convertibility feature that allow you to exchange that bond for 30 shares of stock. So right now, the shares of stock are only worth $900. Face value of the bond is worth $1,000. So obviously you would not convert. But now suppose that the stock went up in price by a lot, and say it doubled to $60 per share. So now it's worth $1,800, and your bond's face value is still $1,000. But you have this option. You can trade in your bond for $1,800 worth of stock. Of course, it seems like a no-brainer. But the idea here is to allow a fixed income or a bondholder to participate in some additional appreciation if the company does extraordinarily well. Now, why would a company want to do that? Why would the equity holders allow it? The reason is that management can issue that bond with a yield that's considerably lower than a non-convertible bond, right? So you're paying for it. You're paying something for this option, but it does have value if things go in the right direction for you. Callable bonds, again, they're a straight bond with an option tagged onto it. Sometimes they call them warrants instead of options. I think of them as an option, though. Callability is on the company side. So a callable bond is a bond that a company issues with a certain coupon rate, but if the interest rates in the marketplace decline, then the company can say, well, gee, I'd really like to refi this. You can refi a house, right, very easily. Well, if you have a callable feature in the bond, you can call that bond back in and you can reissue a new bond with a lower coupon rate. Now, usually, here again, you're going to have to pay for that option. And now remember, this is the company that has that option. So they may have a slightly higher yield than a non-callable bond. The other piece of it is that there's usually a window over which the bond is not callable. So there might be a 5-year window when the bond is first issued where it's not callable. And then lastly, and there are a variety of other warrants and options that you could add to a bond, but these three are some of the more common ones. A puttable bond. So this is a bond, this is a feature added to a straight bond that allows the investor to sell the bond back to the company prior to its maturity date. So if interest rates go up, I might not want to keep this bond at a low coupon rate. And if I can put it back to the company, I can get my principal back, and I can take that principal and go out and buy a higher coupon rate bond. Again, this is basic stuff. I'm sure you saw this in 312 or 521, but I want to just point it out again. Coupon rate versus current yield. The numerator is the same in both cases, annual coupon. It's the denominator that changes. So coupon rate is always going to be the same for the bond. It is contractual. So the annual coupon that gets paid is contractual because the coupon rate is contractual. So that will never change. What does change quite a bit is the current yield, and it changes quite a bit because the price of the bond is always changing depending upon what the interest rate in the marketplace is, the current rate of interest for a given riskiness of the bond. The bond price also changes if there's a shift in the riskiness of the company. So if default risk increases for some reason, then the price of the bond would go down. If default risk decreased, the price of the bond could go up as a function of that. So part of it is a market-induced thing. When market rates change, that can cause the current yield to change. Others are idiosyncratic to the company and the particular issue of the bond. Yield to maturity is another very important concept, and basically we can think of it as current yield plus, because the current yield tells us about the coupon that we're getting back. And the thing that yield to maturity adds to that is that it also deals with that maturity principal repayment, that principal repayment at maturity that comes back to us. So here's a formula that we can use to actually calculate. We could either use it to calculate a yield to maturity, or we could use it to calculate a bond price, depending on whether we solve for that or whether we solve for this. This particular formula is kind of an ugly-looking animal, but if you kind of break it out, this first part, the part that's underlined by the green, is the present value of the coupon payments by themselves. And then we add to it this piece of it, which is simply the present value of the principal repayment. So that FV is the is the face value. It's not future value in this case. Be very careful of that. It's face value of the bond. And again, as I said, most corporate bonds, it's $1,000 face value. And so I've got this little animation for you. So here is, and by the way, this is a photograph of an actual bond issued in 1979 and matures in 1987. This is a treasury note, as opposed to a bond or a bill, right? We've got three flavors of treasuries. This one is the medium term. So it's an 8-year, about it, yeah, 8-year treasury. The other interesting thing to note here are these little coupons down here at the bottom. And so we use that term still today. It derives from this. This is also known as a bearer bond. And that's because whoever clipped these coupons and sent them in, they would receive the coupon payment. In other words, it was the bearer of that bond. Today, we don't have very many bearer bonds, if any. They're usually registered in a person's name, and the coupon is immediately sent to you without you having to do anything. But here, you literally took a scissors and you clipped this coupon off, sent it off in the mail, and a couple of weeks later, you'd get a check back. The beauty of these things was that they were very simple. They were very difficult to trace. So the government said, hey, we don't like this anymore. We want to trace this. We want to be able to make sure you pay the appropriate taxes, yada, yada, yada. Plus, the other part of it is that bearer bonds were extraordinarily risky. I mean, if I had one of these, you would need a safe to keep it, right? Otherwise, if somebody stole it from you, it was theirs. I mean, they could just clip these things off and get the coupons. Again, face value is typically 1,000. In this case, treasury notes and bills and bonds aren't always 1,000, but this one actually follows that corporate face value of 1,000. Coupon rate is always a stated rate, and it does not change. It is contractual. And then there are coupons. Now, here's something to think about. When the market rate, the yield to maturity, is greater than the coupon rate, let's see. When the market, sorry, I said that wrong. The less than sign was correct. I just stated, I was going, wait a minute, this is wrong. When the market rate is less than the coupon rate, the price of that bond will be greater than the face value of the bond. And this will be called a premium bond for obvious reasons. It's selling at a premium to face value. Why is it selling at a premium to face value? Well, because in this particular market, 9% for this level of risk is higher than the market is demanding. So maybe the market's only demanding an 8% return, but I've got a bond that will give you a 9% coupon. So that bond gets bid up, and it gets bid up above its face value because, hey, we bid it up to the point where it actually yields only 8%. Similarly, or conversely, I should say, now I need to get rid of these markings. Hang on a second. Come on, behave. There we go. All right. Conversely, when the market rate or the yield to maturity or the rate demanded by the market is greater than the coupon, then the price will drop below the face value. So that's obviously that inverse relation. Again, you probably learned that in 312 or should have, or 521, the inverse relation between yield and price. And that is called a discount bond. And then when market price or market rate equals the coupon, then the price is equal to 1,000, and that's called a par bond, or it's selling at par or at face. This graph demonstrates the fact that not only is there a premium that gets greater than greater as the time to maturity increases, and the discount gets more severe as time to maturity increases, but it also, if you'll take a closer look at this, you'll notice that that's not a straight line. That is non-linear. So in other words, the premium or the discount that we pay if we're closer to maturity. So here is maturity. Obviously, when it reaches maturity, when we're a day from maturity, all bonds are going to sell at par because that's what we're going to get back. If they're not selling at par, you've got an instant arbitrage, right? So that's why these all converge back here. And notice that we're kind of going in reverse order. So to the left means, to the left. It's shifting me around here. So this is left. To the left is higher maturity. But you'll notice that that premium increases at a decreasing rate. Notice how this curve kind of flattens out here, and it's steeper back here. Same is true of the discount. And what we're going to find is that Mckeel, also the same person who wrote A Random Walk Down Wall Street, came up with some basic theorems to think about this. And this is one of the theorems, is that the premium or discount price increases at a decreasing rate as time to maturity increases. For premium bonds, we can also think about the relation between the various yields. Probably an easy way to think about this is that, for premium bonds, we know that, it's the annual coupon divided by the face value. All right. And when the bond is selling at a premium, it's the annual coupon divided by the price is the current yield. All right. So the coupon rate is going to be greater than that because the price is higher than the face value. It's selling at a premium. So if you just remember that one thing and realize that yield to maturity is going to be even lower than either of those two, then you can get this whole relation. And you just reverse, once you've got that, then you just reverse it for your discount bonds, reverse the signs, and you're there. So the coupon rate is less than the current yield is less than the yield to maturity. And obviously for a par value bond, all of those animals are equal to one another. Let's see. Talking about clean and dirty prices, callability. Why don't we just, there's no particularly good spot to stop, but it's right at 8 o'clock. Why don't we take about 15 minutes and come back at 8:15 and we'll pick up from there. See you in a bit. Hello. Hey, April. Everybody back? Excellent. And by the way, I want to thank you again. I don't want to jinx this, but thank you for, most of you have your cameras on, and I really appreciate that. Okay, so let's keep going on bonds. So this little section again is just more terminology and understanding kind of the mechanics of these things. But just wanted to mention it briefly. Clean versus dirty prices. Most of the trades that occur in the bond market occur between coupon payments, right? And those coupon payments are typically biannual, every 6 months. Sometimes they're quarterly, but nevertheless, the day that we trade it, whoever takes over the bond, they become the registered owner of that bond, and they get the next coupon, even though we might be only a few days from that coupon. So the fact of the matter is that the seller actually, in order for them to be willing to sell the bond, they want to capture that part of the coupon that they were owed while they owned the bond, even though the coupon comes directly to the buyer instead. So what we do is we start off with a clean price, which is just calculated based upon time to maturity, and then we add to it the amount of the coupon that is due to the seller, and that becomes the dirty price. Clean price is, you can think of it as the kind of the marketplace price for that particular bond on that particular day with the current market rate, and then the dirty price would be well, actually, it'd be the same for each seller as well, but it adds in that accrued interest that they're not being paid for directly by the company. So just try to keep those concepts and terms straight. Clean is without accrued interest. Dirty is with accrued interest. Callability, we talked already about that at the beginning of the chapter. There is this concept of call price. So the callability is not, I get to call it at face. Typically, there is some sort of premium that must be paid. And so here's the other rationale. Even though there is a window over which it's non-callable, we also put that premium in there so that just with a small change in rates, companies aren't going to go nuts and start calling in their bonds and replacing them with other bonds. Now, obviously, there are some costs in the millions of dollars to just replace, to call in the old issue and replace it with a new issue. But even at that, we want rates to move quite a bit before we actually get a bond called, because it's just a pain in the neck. To replace that bond, and then investors have to reinvest at new rates and yada, yada, yada. So to protect the investor from that, there is usually a call premium. The call price, instead of being at $1,000, it might be at 10% above that. So it might be $1,100, or it could be $1,200. So rates have to go considerably lower than the contractual coupon on that bond before it's worthwhile for the company to call it. Now, for those of you undergrads, when you take FN 440 Intermediate Corporate Finance, you're actually going to calculate the rate at which it is worth calling a bond. But that's from the company side. But this just gives us, from an investor side, this just gives us some protection that, rates drop by 30 basis points, and they're not going to run out and call the bond. And then, like I said, there's also that initial period of protection where it's non-callable for the first couple of years, sometimes usually up to about 5 years on a typical 20-year maturity bond. The other thing to note about callability is that maybe we don't want to calculate a YTM, a yield to maturity. Maybe what's more relevant for us is what is the yield to call. And underlying that is the presumption that we're in a relatively high interest rate world and rates are expected to decline. Now, in the world that we're living in today, it'd be much nicer to have putability, right? And I haven't gone out and looked at this, but my guess would be that there would be more puttable bonds available today. At least it seems like that would be something that the market might demand and might be willing to pay quite a bit for, is to have a puttable bond. I'd be interested in, I'll have to go out and dig around the research and see if anybody's actually looked at that or not, but it seems like that would be true. Now, so in this particular environment that we're in right now, with rates at historic lows, so close to zero, it's not even funny. We're not really worried about yield to call because rates are going up; they're not going down. But if you were to want to calculate a yield to call, which you will in your homework and on the final exam, this is how you would do it. And the thing that changes here is this CP, and that is the call price. So rather than FV, which was face value, you replace that with the call price, and that call price is going to be, like I said, typically greater than $1,000, depending upon what the company sets. And then obviously the C is still coupon, YTC is the yield to call, and T in this case is the time till the end of the non-callability period. So if we just issued a bond, it's a 20-year bond with a 5-year it's a callable 20-year bond with a 5-year non-callable period. That capital T would be 5. And by the way, I didn't mention this in the other formula. Because so many bonds are make their coupon payments every 6 months, that's why you see this YTC over 2, and why you also see the 2 times T. So if the period is 5 years, there would be 10 coupon payments. There would be 10 6-month periods over which you would calculate this rate. So if you have a bond that's other than that, that's maybe annual coupons or quarterly coupons, this formula will not work. It's fairly easy, though, in an Excel spreadsheet to come up with any sort of periodicity for bond calculations. Formulas are a lot less valuable with the advent of easy-to-use Excel. Some of the risks that we face, obviously there's default risk, right? Default risk is that risk that the company is unable to make the coupon payments and maybe even unable to repay the principal on the bond. But then there's this other type of risk that all bonds face, even if you've got a Treasury, which should have virtually zero default risk. Although I will tell you that and this is a non-political party denominational problem because both George W. Bush and Bill Clinton actually floated what turned out to be a rather lead balloon on defaulting on a Treasury. My God. I mean, they both floated it out there, and it was met with a resounding thud. How stupid can they be? But anyway, like I said, it's non-denominational in terms of political parties. They both did that. Clinton back in the 90s and Bush in the 2000s, early 2000s. But so default risk is something that we can get a pretty good handle on by looking at bond ratings. Right, we've got Moody's, we've got S&P, and we've got Fitch. Those are the 3 primary bond rating agencies. We looked at those, I think it was back in Chapter 3, right? And we talked about a little bit about those bond rating agencies get paid by the issuer. So there's a slight fairly serious conflict of interest. But nevertheless, we can get a pretty good handle on default risk. Interest rate risk, on the other hand, is more systemic as opposed to idiosyncratic to the particular company. Interest rate risk is more of a market-wide issue. Interest rate risk is a possibility that interest rates change, and they'll result in either a loss or a gain in the value of the bond. And that's also why a realized return is going to be different from the yield to maturity or the promised yield. Think of those as synonyms, those two. But the realized yield means, hey, this is what I actually end up with. And the reason that that is the case is when you think about a bond, what you may not be thinking about is, okay, so we've got, here's our time to maturity. Got a bunch of coupons that show up here. 1, 2, 3, 4, 5, 6, and 7th coupon. So we get, I don't know, let's just do $50 per coupon. And then we get our 1,000 plus that final coupon payment back here. Now, when we calculate the value of that bond, the price on that bond, what we're doing is we're going to divide each coupon payment by the yield to maturity raised to the period, right? So here it's 1, here it's, I'm just going to abbreviate with y to save space, it's squared, and here it's 3, and so forth. Out here we're dividing by yield raised to the 7th power. So we've got 7 periods. So you can think of it as discounting it back that many periods. However, another way to look at a bond, and this is helps on the intuition, we could move that value anywhere on this timeline. We just happen to be bringing it back here to time 0, but we could easily move it out here to maturity. We could put it anywhere on this timeline, and we could just gather all of those present values, or at that particular time. So instead, what we could do is we could gross up that 50, this 50 right here, and instead of going back 1 year to time 0, we could bring it out here to year 7 by saying 50 times YTM raised to the 1, 2, 3, 4, 5, 6 periods. All right. And then we could add to that the next one right here, grossed up at yield, YTM, for 5 periods, and so on down the line for 4 periods and so on. Add that all up, and that's the value of the bond in period 7, or at the end of period 7. Okay. That brings up an interesting point here. So we're reinvesting those coupons, and we're reinvesting them at the yield. And now once we've got that value, let me just kind of complete the circle here. We could take that value that's out here at year 7 on maturity date, and we could bring that whole lump sum back to time 0, and we would have the exact same value on the bond as what I first demonstrated up here in the red. It'd be exactly the same. So what that means is that I have this implicit reinvestment assumption in all of my bond prices. And the reason that they're worth what they're worth is that that reinvestment assumption is there. And the reinvestment assumption says I'm going to reinvest at the same rate that I face right now, today, even though I know that tomorrow it's going to be different, the day after that it's going to be yet different again, and 6 months from there it's probably going to be different too, right? Rates move a lot. They go up and they go down. Now, you might not believe it because you've lived through like the longest historic low, close to 0 interest rate period ever in history. But believe me, the rest of history is littered with various changes in rates. So to the extent that rates do not follow the assumption that we have right here, then our realized yield is going to differ from our expected or promised or yield to maturity rate, because there's that reinvestment assumption. We're reinvesting these coupons at YTM. Now, is there a better way to do it? You know what? today's estimate of yield is probably the best estimate for the future too, because it doesn't change until we get new information in. So we don't know what that information is going to be. So yeah, we don't have a better method. What we're going to see in a little bit here, and this is kind of the cool part about fixed income, and this is why, actually, given that many more of you will be working in this area than in equities, that it's really kind of a cool area to work in. There's a lot to do, a lot of moving parts and things to analyze. What you're going to find is that we can pick a particular time, and it's typically before maturity date, where if yields do change a little bit, I can insulate myself from those changes. And I can guarantee a known amount on that date right there. Maybe it's one period, or, let's say maturity here is 3.5 years. And so maybe it's this particular point is at 2 3/4 years. We're going to call that point duration. And we'll talk more about that in just a second. But I wanted you to start thinking about this idea that really implicit in the bond price formula, the discounted cash flow formula, is an assumption that we're reinvesting those coupons at those same rates. And to the extent that those rates don't exist in the future, my realized yield is going to be different from my promised or yield to maturity. Okay. Interest rate risk and maturity as it pertains to the value of my bond. So just a minute ago, we were talking about coupons in particular, but also there's this inverse relation between yields and bond prices. You'll notice that these are both downward sloping. That's why it's an inverse relation. As yields go up, prices go down. As yields go down, prices go up. All right, so we start here at face value. And so in this particular case, we price these bonds, or we put an 8% coupon on both these bonds. How do I know that? Well, because the lines cross there, and they cross at 1,000. So these are both par value $1,000 bonds with a coupon of 8%. Now, if the yield in the marketplace declines in a future period prior to maturity of these two bonds, let's say it declines from 8 down to 6. Well, the price of our bond here, this is a 5-year bond. Let me clear this junk off. So the price of our 5-year bond goes up by a little bit, not by a lot. Need a better color. Goes up by that amount. So here we are. It's at like $1,100. Price of our 20-year bond, though. So if yields drop from 8 to 6, now the coupon you're going to get every year is $80. For the moment, let's just assume this is an annual coupon instead of semi-annual. Now, a 5-year bond, we only have 5 coupon payments to worry about. Now, we're paying $20 per year too much. So how do we adjust the yield on this bond? We increase the price by some amount. And in this case, actually, now that I say that, I know it can't be $1,100 because that's $20 and the present value is smaller than that. So it's actually more like 1,000, let's make it 1,060, right? All right. Now, a 20-year bond has 15 more additional $20 payments that we don't need to give to whoever we're selling this bond to, because the market is only demanding 6% for a similar risk. So in that 20-year bond, the price goes up even further to kind of recoup that overpayment of the coupon. The seller is recouping some of that. And by raising that price, I'm decreasing the yield, the effective yield of my bond that has an 8% coupon. I can't change that coupon. That's contractual. What I can change, though, is the price of the bond. And by raising the price of the bond, I decrease the yield. Vice versa, if yield goes up and I still want to be able to sell that bond because, hey, I've got an 8% bond. Everybody else with new bonds, they've got 10% bond. Nobody wants my bond. The only way I can get people to buy my bond is to lower the price. And again, the 5-year is lowered from 1,000, but it's not lowered as much as the 20-year because the 20-year has an additional 15 years where I have to make up for extra payments that I should be getting that I'm not getting. So what I'm doing here, remember, this is we make this payment either at a premium or a discount today, and then we get whatever the coupon payments are in the bond contract itself, and then it's not until we get to the maturity date that we get back the principal. So let's say we only paid $800 for this bond. 50 or 20 years later, we get back 1,000. So we get an extra $200 at that point, and that's supposed to make up for not getting a 10% coupon for those 20 years. And vice versa, if it's selling at a premium, we pay $1,200 for a 20-year bond that has a coupon of 8, but it's priced to yield 6, but we only get back $1,000. So we lose $200, and that $200 loss is to make up for the fact that the bond has been paying $80 instead of $60 every year in interest. But make sure you get the idea that these relations first are inverse between price and yield. As yield goes up, price goes down, and vice versa. And also notice here too that not only is the maturity got a different slope to it, the higher the maturity, the greater the price impact for a given change in yield. But also notice that these are nonlinear animals here. So this is not a straight line, right? It's a curve. And it flattens out as we go to higher yields. And even this pink line here has a slight curve to it. So it's a non-linear relation. So here are Mckeel's theorems. There are 5 of them that we're going to look at. And the first one is pretty clear. We've already talked about it a couple of times, and that is bond yields move in opposite directions to bond prices. So prices and yields are inversely related. 2, the longer the term to maturity of the bond, the greater the magnitude of the change in the bond's price. Oh, that's the slope thing here, right? The 5 years like this, the 20-year is got a greater slope to it, steeper slope to it. So that's the second theorem. Both of these are pretty obvious. 3, 4, and 5 get a little more convoluted. Okay, so 3, the size of the change in the bond's price increases at a diminishing rate as the bond's term to maturity lengthens. All righty. That one is not so obvious here. The size of the change in the bond's price increases at a diminishing rate. So a 5-year bond versus a 10-year bond, that's a 5-year difference, is going to have a bigger shift in the slope of that price yield line than if we were to take a 20, compare it to a 25-year bond. That'll have a much smaller change in slope. It'll still get steeper, but it won't be quite as much. So that's really what 3 is talking about. It's saying, holding that difference the same, 5 years. So we go from a 5 to a 10-year bond. that's a much bigger shift. And we go from a 20 to a 25-year bond. Let's see, they're up here. And then that shift is smaller, much smaller. Okay. Theorem 4, the resulting percentage change, and that should just be 1, sorry, in the bond's price is inversely related to the bond's coupon rate. The resulting percentage change in the bond's price is inversely related to the coupon rate. So higher the coupon rate, the lower the change in the bond's price. Well, again, that makes sense because a given change in yield is going to be a smaller percentage change in yield, right, as I have higher coupons. So today, we're in such a low coupon that any small change in yield is going to relate to a much bigger change in price. And then finally, the magnitude of the price change caused by a decrease in yield is greater than the price decrease caused by an increase in yield. Okay, so magnitude of the price increase caused by a decrease in yield is greater than the price decrease caused by an increase in yield. We can see that on this graph, can't we? Remember I was talking about the nonlinearity of this thing and how it's becoming steeper to the left and more horizontal to the right? That's the fifth theorem, Mckeel's fifth theorem, is that. So the increase in yield is leading to a less decrease in price than a decrease in yield leads to. And that creates this nonlinearity. And you can see it most clearly in the 20-year, but it's still there. It's even there in that 5-year as well. Okay. A couple of other interesting things. I don't think the text doesn't really get into this, but if we're looking at the same thing here. We've got bond price on the y-axis, and we've got yield on the x-axis. And here, this dark line, this black line, is the straight bond pricing relation between straight bond relation between bond price and yield, and it's inverse, so it's downward sloping to the right. All right, now we add a callability feature to it, and what's that do to this pricing function? Well, it flattens it out right here. Because at a certain point, as yield declines in the marketplace, remember our coupon is fixed contractually. As yield declines, at some point, that bond is going to get called. So that truncates so that if we have a callable bond, this part of the curve doesn't exist. And we've got a pricing relation that looks like this. Now, if we have a puttable bond, it's on the other side. And in the case of a puttable bond, as yield goes up, we are going to think about putting the bond back to the company. So the bond price levels out at this point. So the rest of the curve follows this, and then it flattens out. Now, if we had a callable and puttable bond, it would follow this. I don't know if there are such animals out there. I've obviously I've had a seminar in fixed income securities, but we didn't get into callable versus puttable, and whether there are bonds that have both features. I don't see why there couldn't be. I just don't know whether the market demands that sort of thing. Bond prices and yields, I'm not going to go over this. It's just really kind of takes a numerical look at that graph that we're just looking at. I think the picture is more valuable, but you can certainly take a look at this if you want to walk through some of that with numbers rather than pictures. Now we get to what I think of as probably one of the coolest things about bonds, and that is duration. Okay. And when we talk about duration, we have this thing we call Macaulay duration. Mind you, we're not talking the Home Alone Macaulay, all right? This is Frederick, not Macaulay Culkin's, right? Too old a reference? Okay, everybody's like, what are you talking about? I'm sure you've... Yeah, yeah. Yeah, Home Alone, right? Didn't I? Yeah. I thought I said that. Yeah, I'm sure. Come on, you guys have seen that. Yeah, it's gotten rerun tons of times. All right, but Frederick Macaulay is the person who came up with this idea. And as with anything in research, these ideas were floating around a lot, probably. It's just that Frederick happened to be the first one to actually publish a paper on this. And so he gets credit for having developed this. But for the most part, it's really a community effort. So now, bondholders know that the price of their bonds will change when interest rates change. The question then becomes, how big will that change be, and how is this change in price estimated? Well, we could go back to this pricing formula right here, or this graph. Let's forget about the callability and the putability features. So we've got this nice nonlinear relation between bond price and yield. By the way, notice, and I think some of my slides are carryover titles from the authors. Too many people misuse relation versus relationship, right? Kind of one of my pet peeves. And I see this a lot in even academic papers. A relationship is something that two people have. A relation is something that two variables have. Okay, so when you see relationship in your textbook, unless they're talking about banker versus client or manager versus investor relationships, which that's a possibility, they should be using relation. All right, back to the main point. So we've got this relation between price and yield. At any given yield, we can see what the price is. Now, if yield goes up by a little bit, we can see what happens to that price. It declines. If yield goes down by a little bit, price goes up. And remember, this is nonlinear, so the change in prices, even for the same amount of yield decrease versus the increase, that change in price is going to be different because of this nonlinearity in the relation between these things. And that all goes back to the fact that bond price is the sum of the present value of all the future cash flows that bond generates, discounted by YTM raised to the tth power, and we've got T equals 1 to cap T. That's how we're getting this graph. We're taking different yields and we're calculating a bond price using this formula. It's the same as that closed form solution that we were just looking at earlier, that YTM formula, bond price formula. But that's how we get this. We could just plot it for various things and we'd get this nice smooth curve. So actually, the answer to the question that was just posed on the slide down a couple of slides back in the deck is that that's how we determine it. We could actually do something like that. Now, not especially at the time this was developed, this idea of duration, that was a little more tricky to do because we didn't have easy access to computers, right? I mean, this thing right here was going to take up an entire building. I don't know if you've seen pictures of, a 20 megabit drive, with a forklift lifting it into an aircraft, to carry it around, and it's liquid cooled. Now, 5 megabits, I mean, that's smaller than most of the images when I shoot my DSLR. They're like 35 megabits. So all of this stuff was developed way back when computing power was difficult and we needed some shorthand. So to some degree, duration has lost a little of its luster because now I can easily plug this into a computer and I can get the answer. So don't be surprised that, you're reading this and you're going, well, just plug it into Excel and I get the answer. Right. We can now. But the silver lining is that duration is still extraordinarily important. We're going to see why beyond just the simplicity in estimating how the price changes. But before I move from this slide, so if I could draw a straight line, and sort of. And many of you, especially undergrads, you guys all took calculus. So you know what a derivative is, right? And you know what a first derivative is, right? First derivative evaluated at this point is the slope of that curve. That's the first derivative. And that also is duration. So, if I just wanted to approximate how price is going to change for a particular bond, and remember, these price yield relations are different depending upon maturity and coupon rate and all of these other, the market rate of interest and so on. So if I wanted to shorthand, I could get the duration of that bond, and at least over a pretty sizable range of possible yields, I could approximate it with this linear relation instead of the nonlinear relation. It makes that a heck of a lot easier. And in fact, there's even a convexity correction that people have used in the past. It's almost like using an abacus today instead of a calculator, right? I don't think anybody uses the convexity correction, but I do want you to know that this is what duration is. It is the first derivative of the price yield formula. Okay? All right, hold on to that. And the fact is that makes it a lot simpler to calculate price. I can calculate if the yield changes by 10 basis points or 20 basis points. I've got duration. I can get price right away. I don't have to go through a bunch of calculations to get it. All right. And in fact, percentage change in price is approximately, and that's what those squiggly parallel lines mean, equal to minus times the duration times the change in the yield over 1 plus YTM over 2. And again, the YTM over 2 is because we're assuming this is a semi-annual coupon payment on the bond. So two bonds with approximately the same duration have approximately the same price sensitivity to a change in yield. Now you'll also notice that back here, as we go further away from the current yield, this linear approximation gets worse and worse. Now I've got a bunch of errors. So the linear approximation tells me price for this yield is here, and in fact, it's actually up here. Or lower yield, it's here instead of up here, right? But it is pretty good for this range right here. 50, 75 basis points either side, which is fine because rates don't change that fast. All right. Now, we're going to take this Macaulay duration and we're going to do just a little tweak to it. And in fact, what we're going to do is we're going to divide that Macaulay duration by 1 plus YTM over 2. See that right there? And we're going to call that modified duration. Now we don't even need to deal with the division there to get the change in the price of the bond. Come on. So with the modified duration, I can get the change in the bond price by saying modified duration. It's unfortunate that modified is an M, Macaulay is an M. Don't make that mistake. If you see MD, that doesn't mean Macaulay duration. That always means modified duration. So now percent change in the bond price is modified duration times the change in YTM. Simple, easy peasy. So now you can do it in your head. If I were to use just the Mckeel, not the modified formula, here they give you an example. If the yield to maturity increases to 8.5% from 8, what would the percentage change in bond price do? It would decrease by about 5.3%. And likewise with this, here's the pricing formula using modified duration. There, all you have to do is take that one single number, whatever it turns out to be. It's the slope of that first derivative of the price yield function, and multiply it by the expected change. In this case, that prior example, that's 50 basis points, 0.005. Simple. Now, we're going to look at some of the relations between duration and various characteristics of the bond, like coupon rate, time to maturity, things of that. So kind of think Mckeel's theorems, except as it relates to duration. One of the first ones that's very easy, a zero coupon bond has a duration that is exactly equal to maturity. So, and now what I really need to do is to, and I don't know that, yeah, it's not in here on the slides. So let me go here to the blackboard. I don't think we're quite going to make it through this chapter, but this is very important to calculate duration. You could use some of the formulas that they give you in the book, but I think this is much more intuitive. So we're going to use a summation. And remember, a summation is simply a shorthand way of saying we've got a bunch of elements in here and we're going to add them all together. And those elements are going to start with the next coupon payment, and they're going to go to the last coupon payment. And that last coupon payment is also going to have the face value of the bond attached to it too. So we're going to get both of those back at time t. That's maturity. All right. Now, we're going to take the cash flow that occurs at time t, small t, and we're going to divide that by 1 plus the yield raised to small t. So we're getting a present value of the teeth cash flow. So if I wrote that out in long form instead of using the summation notation, that would be cash flow for period 1, which is our first coupon, the next coupon, divide by 1 plus whatever our yield to maturity is, raised to the first power. Now, this is looking a lot like the pricing formula for a bond, right, up to this point, because that's really what it is. I'm going to add 2 additional elements here that are going to change that. I'm going to divide that whole thing by the total price of the bond, right? So let me just go up here. The price of the bond is simply the sum from little t equals 1 to cap t of all the future cash flows discounted at the market yield for t periods. That's price. So that's why when I, where is that? Okay. That's why this piece of it right here, that's the pricing formula, right? And let me go back to blue. Okay, so now I've taken that present value and I've divided it by the sum of all present values. So we can think of this piece right here, that is a percentage. And in fact, that percentage is what percentage of the entire value of the bond am I getting back next period? So if I divide this by price, that gives me some percentage of the bond that I get back in the next period. All right? Making sense so far? Okay. Now I'm going to do one additional thing here, and I'm going to multiply this result by t. So here, what I'm going to do is I'm going to multiply this, because this is the first period, little t equals 1. I'm going to multiply that by 1. All right, then let me just continue this for the next period. This is the second coupon. I discount it back at y for 2 periods. That's the present value of that coupon. And then I'm going to divide that all by price, which is the sum of all present values of the cash flows. And then I'm going to multiply that by 2. So let me just kind of clarify here. I'm going to put some brackets around this. Not really necessary, but might be helpful to illustrate. So this particular, these two elements, again, different color. These two elements right here are the first 2 periods of this formula. Now we have up to capital T periods. So if time to maturity is 10 periods, then capital T is 10. So we would have, in that case, we would have 8 more elements to this. So we'd have the third cash flow discounted for 3 years at yield divided by price times 3, and so on up to 10. We would add all of that up, and that is duration. So you're saying, okay, I get the math, so where the heck is the intuition? Well, the intuition is here. You can also think of duration. And unfortunately, Wolfram has some visualizing elements here, and they do have a way of visualizing duration. I couldn't get the thing to work. Wolfram is an app that you can do various types of programming to create visual elements that change as you change parameters. But let me just draw it out. You all have, at one point in your life, hopefully probably not anymore unless it's with nephews or nieces, played on a teeter-totter though, right? So we can think of duration as a fulcrum, and out here we have maturity. So we have a very big payment coming back to us. That's the face value plus the last interest payment, but it's a present value. And then we have coupon payments over here. I'm going to kind of simulate what Wolfram was doing with this. And then what we're going to do is we're going to take we're only going to account for the present value of that. So whereas the total payment here is $1,000 plus the coupon, the present value of that is just this red part of it. And then the present value of each coupon payment, this one is going to be really small. This one's going to be a little bit bigger. This one's going to be a little bit bigger, because as we get present value nearer times 0 over here, this is times 0, this is maturity, then the present value of that thing is much bigger. But the point is that we've got these things, and think of that red as a weight equivalent to the percent of the cash flow that you get back, of all the cash flows that you get back on a present value basis. And we're placing that fulcrum at a point where that teeter-totter exactly balances. That is duration. That point is duration. And again, I see you all shaking your heads, not physically, but internally going, oh, great, that was really helpful. So let me, we've just got 10 more minutes, but let me just take the next 5 minutes to really try to drive all of this together and bring the intuition, and we'll pick this up and put a few more fine points on it next class period, and then we'll jump into chapters 11 and 12 where we start getting into the CAPM and that development. But so here is the real intuition. So you've got kind of the mathematical, you've got a visual piece of it. Now, remember I said that embedded in that pricing equation when we price a bond is the idea that we reinvest the coupons at the yield to maturity. But we also know that that yield to maturity is not always going to be the same in the future when we have to reinvest those coupons. And we know that there's an inverse relation between yield and price of a bond. So let's say that I buy a bond and the yield goes up. What happens to my price? It goes down. Sorry. All right. But when yield went up, that means my reinvested coupons earn more. Right? Now, this idea of duration is that for small changes, and by small we're talking 20, 30, 40, 50 basis points at most. So have up to maybe 0.5%, depending on the bond, of course. I can use duration to insulate me from those changes. Because if, let's say that interest rates went down, the value of my bond would go up. And if I held it to maturity, I would still get the coupons. But what if I wanted to get rid of it earlier? Or what if I had a date that I needed a particular amount of money? Well, I'd have a problem. I'd have a bigger problem if yields went up and the price of my bond went down. So how do I contend with that? How do I create some certainty here? This idea of duration helps me to create certainty because what I gain, let's say yields go up. So I gain by reinvesting my dividends at a higher yield, but I lose in the value of my bond when I cash it in or sell it. The amount that I lose in the value of the bond, if that's exactly offset by the increase that I get by investing at a higher yield, my coupons, that point is duration. And I can insulate myself from small changes in interest rates. And if I need $1,000 in 5 years, I pick a bond with a duration of 5 years. I don't pick a bond with 5-year maturity. That would be wrong. I pick a bond that has a duration of 5, and as long as rates stay relatively close, within, say, 50 basis points of the current rate, either side, either up or down, I will have my $1,000 at the end of 5 years. Why is this important? Because pension funds, they have known payouts, right? We've got a bunch of, if we have a defined benefit pension fund, we know that we're going to pay our pensioners, we owe them, say $10 million in 5 years. How do I make sure I have that $10 million? If I put it in equities and the market crashes, I'm screwed. But I can put it in bonds. And if I use a duration of 5 years, I can calculate how much I need to put in today to have exactly that $10 million that I need in 5 years. And I'm still getting a decent yield. Now, as we get closer to that 5 years, duration starts shifting and I have to adjust my bond portfolio and yada, yada. We'll talk about that next class period. It gets more complicated. The devil is in the details here. And that's also why there are so many jobs in fixed income. But I want you to leave tonight with this idea that not only is this kind of the balance point of the present value percentages, let's see, the percent that each one of these is of the total present value of the bond, or in other words, the price. But I want you to more so think about the idea that when yield goes up, my reinvested coupons earn more, even though the value of my bond goes down. And when yield goes down, my value of the bond goes up, but that's offset by lower yields on my reinvested coupons. And when those two amounts are equal, in fact, at duration, if I have a holding period that is equal to duration, those two amounts will be equal for relatively small changes in interest rates. And that's a very important concept when it comes to managing a portfolio of fixed income instruments. All right. So we were talking about duration and Macaulay's duration, and then we divided that by 1 plus YTM divided by 2. We called that modified duration. But the idea of that duration was that it was giving us what we can often call an effective maturity date, right? Talked about effective returns versus cumulative returns. This is an effective maturity date versus an actual maturity date. Now, a zero coupon bond, the duration is exactly equal to the maturity date. The reason is that there is no cash flow prior to maturity with a zero coupon, right? By definition, no coupons, zero coupons. So we buy it at a discount, and on maturity date, we get back the face value. And that difference between the price that we paid and the face value is our interest. But there's only one single cash flow. The idea with duration is that it gets shorter, the effective maturity gets shorter because we have more cash flows between the time we buy the bond and the time it matures. So a coupon bond the duration is the weighted average of the individual maturities of all the bond's separate cash flows. So that means each and every coupon that gets paid, where the weights on this are proportionate to the present value of each of the cash flows as it pertains to the sum of all those cash flows, which is the price. So when we looked at that formula on Tuesday, where it was duration is equal to the sum from t equals 1 to maturity of the cash flow at time t divided by 1 plus the yield raised to the tth power divided by price, and then times t, that period. That's our basic formula for duration. So this is the present value of the cash flow right here, right there. This whole thing is the percent that present value cash flow makes of all the cash flows in present value terms. And then we take that percentage and multiply it by the period that we are in. So first cash flow, whatever its present value is, divided by price, gives us some percentage or decimal, so 0.05, so 5% of the total cash flows at period 1. So that might be 6 months from now. And we do likewise all the way up to maturity. We add that up, add all those guys together, and that is the effective maturity. Okay. So, come back here. There are various formulas, and you'll work through some exercises in the homework that use these formulas. These are sometimes can be a little quicker than if you're using that summation formula that I just gave you. The summation formula is always going to be right. Each one of these formulas, though, is designed for a specific situation. So this par value bond duration formula is only good for a bond that is selling at par. Now, in the real world, that's a fairly small set of observations, right? Even at the time we issue it, the bond isn't always selling exactly at par because the market rate of interest changes, on a continuous basis. But, homework exercise, we can do this. Here's another formula for a bond paying a constant semi-annual coupon that isn't selling at par. And you can use this. And notice here that this is the piece in here and right here that it differs. So we've got a coupon minus the yield, the market rate, and the yield plus the coupon times this animal in here. Not a lot of intuition to draw out of these. That's why I show you that summation formula. There's a heck of a lot more intuition in that. And I'm not going to work through that exercise. You can just do the math through there. Some of these properties, though, are pretty important to understand. So remember, we did the Mckeel's properties of a bond in general. This is kind of the corollary, but as it relates to duration. So all else equal, or ceteris paribus, the longer a bond's maturity, the longer its duration. So if we have the same coupon, if we have the same risk, we have the same market conditions, and we just move the maturity from 10 years out to 15 years, the duration is going to extend. So maybe if it was originally 8 years, it'll go out to, 12 years. So that's all that says. Again, property 2, all else equal, the bond's duration increases at a decreasing rate as maturity lengthens. And again, this is a lot like what we saw with Mckeel's properties as it relates to bonds and the relation between price and yield. That's not too surprising. So, how the duration moves is as the bond's duration increases as maturity lengthen, it increases at a decreasing rate. So think of that as that second derivative. Property 3, all else the same, a higher a bond's coupon, the shorter its duration. Now this, I think, is a little more interesting because think about it this way. We're getting more of our cash back sooner. The higher the coupon is, we're getting more of what we bought the bond for back right away. If we have a very low coupon, most of the weight is way out there at maturity date, right? Because we get back our face value plus the last coupon payment. But if those coupons are really big relative to face value, maybe they're 10%. There have been periods of time when we had double-digit interest rates. So 10% wouldn't be unusual, 50 years ago. So that's an important thing to keep in mind. The higher the coupon, in other words, the quicker we get our money back in the form of coupon payments, that brings duration closer to us. Property 4, all else the same, the higher the yield to maturity, the shorter the duration. And again, there's a lot of intuition in that. If yield is our discount, that's what we're discounting at. So that means that stuff that's further away out towards maturity has much less value in present value terms. So lower percentage. So that brings duration back closer to us. And this just gives you a visual of that in terms of how we've got duration here on the y-axis and we've got maturity of the bond on the x-axis. And you'll see how certainly it flattens out for a 15% coupon bond much more than it does, say, for a 5% bond. And you'll notice that as maturity of the bond goes up, duration goes up as well, but at a decreasing rate. Value of an O1, don't even worry about this. I think I may have a homework problem on the 32nd, but the value of the O1 is really the most meaningful one. Both basically the same idea. An O1 is simply 1 basis point, 1/100th of a percent. A 32nd is 1/32nd of a basis point. Bonds still persist to trade in 30 seconds sometimes. Stocks, we've moved away from that. back in 2000. Let's see, we started in 1997 and converted all stocks by I want to say it was 2001 when all stocks were converted back to decimals. It used to be that stocks were traded in eighths or sixteenths of a dollar. Bonds still persist in 30 seconds, some of them, but an 01 makes much more sense. And I think the market is, even in bonds, is moving towards decimal instead of fractional type of prices. So how do we calculate an 01? It's we use the negative of the bond of the modified duration times the bond price times 01, 0.0001. That's 1/100th of a percent. Here's some, suppose we've got a bond with a modified duration of 8.27 years. What's the value of an 01? We can calculate that. I'm not going to go through the math, but that tells us that the bond's price change is going to be 7.6 cents for a 1 basis point change in the yield. All right. This part of it, this back end of the chapter, the very last stuff, is probably the most valuable in terms of usefulness of duration, right? Remember on Tuesday I told you that duration could be used to help us estimate a price change in a bond given a change in the market yield. But today that's not quite as important as it was in the pre-computer days when we had to actually compute this thing and we needed some simple metric to do that. Today, we've got computers that can do that in tiny fractions of a second. So what makes duration more important? Well, it's this idea of having a dedicated portfolio with a target date. Okay, so a dedicated portfolio is a portfolio of bonds created to prepare for a future cash payment. And pension funds are really a great example of this, and there still are a lot of pension funds around like this. Not as many as I would wish for, because pension funds are shifting to defined contribution as opposed to defined benefit. Defined benefit pension plan means that you pay into this thing, and when you retire, you get some sort of guaranteed payback on a monthly or quarterly or annual basis. A defined contribution plan means you put in a particular amount into the market and you get back whatever the return on your invested assets is, plus your principal. So this dedicated portfolio is more, and pension funds in particular, this situation is more relevant for a defined benefit plan. By the way, if you're out in the job market looking for a job and somebody offers you a pretty good defined benefit plan from most of the time government, but some companies will do a defined benefit plan. The only risk with the company is that sometimes they will shift the obligation to the government. The PBGC, the Pension Benefit Guarantee Corporation, is a government-run means of dealing with companies that have gone bankrupt. So be careful if it's a private company, because you get a hedge fund that comes in or a private equity firm that comes in and buys the company up. One of the first things they try to do is to dump the defined benefit plan on the PBGC. But these things, as a employee of the state of Texas for 7 years, I participated in a defined benefit plan. It's a really great deal. So if you happen to be in any sort of situation like that, that's a valuable asset, because I look at it as uncorrelated with even the market itself. Right? Because I'm going to get X number of dollars per month from the state of Texas for having worked at UT El Paso for 7 years. And it's a function of the salary I had, number of years of service, and then they have a rate that a percentage that they calculate the annual benefit on. And again, look at that annual benefit. percentage, because that's also important to make sure that you get as high a value as possible. That varies from company to company or state to state. But onto the punchline here for all of this. This example I want to spend a little bit of time going through because I think it illustrates this idea of duration extraordinarily well. So we've got Safety First Pension Fund estimates that it must pay benefits of $100 million in 5 years. Now, obviously, they've also got benefits that they have to pay in 6 years and 7 years, and we're just dealing with one of the payments, but there are multiple payments that we could do the same thing for. Safety First decides to buy coupon bonds yielding 8% to fund this obligation. Why coupon bonds? Why not equities? Well, because in 5 years, it's a pretty short horizon. Putting money that you need in 5 years into equities is really dangerous. And you're looking for trouble if you do that, because there's a good chance that that equity value will go down at any point, and it may not be back up high enough to allow you to make the payment. And when we're talking about a pension, we got to pay that. You've heard of underfunded pension plans, right? Yeah, pension plans that don't have this all set up like this are probably underfunded. All right, so we're going to use these coupon bonds. They pay semi-annual coupons, and they mature in 5 years and are currently selling at par. If the interest rates do not change over the next 5 years, how much money does Safety First need to invest today to have its $100 million in 5 years? So now we're first go around here, we're making the assumption that we are not going to change interest rates. Unrealistic, but it gives us a baseline to start from. And doing a little bit of calculations here, we're looking for a future value of $100 million. And we've got our yield is 8% on a semi-annual basis, 5 years or 10 periods, 10 six-month periods. And to get the present value of that, it's a simple calculation. We need $67.556 million invested today to end up in 5 years with $100 million, with the assumption that interest rates don't change. Now remember, implicit in that pricing formula is that we're reinvesting those coupons that we get every 6 months. So we're putting them back into the same bond that we're assuming is going to yield 8%. But if rates go down, we're only going to get 7% or 6.5%. So we're putting ourselves at some risk here. How do we avoid some of that risk? That's where duration comes in. That's where dedicated portfolios come in. So we've got this. We need a bond that sells for 67.556, or we need to create a portfolio that has that value. Face value, with this face value, the coupon payment every 6 months is the 67.556 times the 4%. So we get coupon payments every 6 months on the order of 2.7 million, a little more than. So we're going to reinvest those coupons at 8%. And so the future value of all those reinvested coupons. So we've got one coupon 6 months from now that we invest for 4.5 years at 8%. That's the first 2.7 mil. And then we've got another coupon that we get a year from now, which gets invested for 4 years at 8%. And then we get another coupon a year and a half from now that's invested for 3.5 years at 8%. So all of those added up brings us to $32.44 million in coupons plus interest that we receive from reinvesting those coupons. So we add that together with the face value, and voila, there's our $100 million. Okay? And as I say, huge assumption that interest rates aren't going to change over the 5 years. Now, if they didn't, we'd be perfect. and we'd be able to pay our beneficiaries what they're owed in 5 years. And we'd have other portfolios like this that would be designed the same way for, 2 years, 3 years, 4 years, 5 years, 6 years, and so on. Now, the money that's 10 years out or 15 years out, a large part of that is still going to be in equities, right? Because we can take that risk with that kind of horizon. But once we get closer in to that obligation, then we've got to shift our money into less risky assets like bonds. So this reinvestment risk that we were just talking about is the uncertainty about the value of the portfolio on the target date. So right here, are we going to have that $32.44 million? I mean, if we have a face value of 67.5, yeah, we're going to have that. If it matures in 5 years, we're going to get that back, assuming no default risk. But will this be 32.4 or will it be only 30? It might be 35. We don't know. And that's the risk we're trying to get rid of. One simple solution is to buy zeros. So we put in our 67.5 million today at 8% in a zero. We get nothing between now and 5 years from now. And then in the 5th year, we get our 100 million back. Voila, we're done. Piece of cake, right? Yeah, well, the trouble is that everybody likes zeros. For that reason, right? They're very safe. We don't have to worry. The only thing we have to worry about is default risk on those. And if we're talking a treasury or like a investment grade corporate, AAA, AA, hey, we don't even worry much about default risk. So these things get bid up in price. What's that mean? The yield is coming down. So we're not going to get 8% on those suckers. And even worse yet, there aren't enough of them around to do all of the things, to serve all the pension plans, to serve all the needs of dedicated portfolios with target dates. So we just simply don't have the option of always going there. Sometimes we could, for sure. Treasury strips are one way of getting a zero coupon bond. I'm not going to go, given our time here, I'm not going to go into too much detail, but this is kind of an interesting little thing too. You take a treasury bond and you strip all the individual payments. I'll show you a little bit of this, but so I've got some sort of, let's make it, I don't know, let's do a 10-year bond. So we're standing here. Maturity is out here in 10 years. And this is a bond, so it's paying, or actually, I think it's a bond after 7 years. Otherwise, it's a note. Anything less than a year is a bill. So we've got a coupon payment here, another one here, another one here. Got a coupon payment at each one of these. And then we get that last coupon payment with the big principal repayment at the same time in year 10. All right, so what we do when we strip a treasury, we take each one of these payments and we bring it down here by itself. And so this is now a 1-year zero coupon with that value, whatever that value is, however big that coupon is, that's what it is. Now we take this one down here and that becomes a 2-year zero coupon with whatever that value is. That's the face. That's what we get at the end of this thing. So we're going to sell it at a discount to that. And that becomes a 2-year zero coupon bond. And we take this one, we strip it off, and we've got now a 3-year zero coupon bond with this face value. And we sell it at a discount back. We're selling all of these at a discount back here at right now, times 0. So now we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 zero coupon bonds that formerly was one single coupon paying treasury bond. Why do people do this? Well, let's go into the, and again, I promised I wouldn't spend too much time, but I gotta show you the yield curve a little bit. So we've got maturity on the x-axis. We have yield on the y-axis. So you may have heard people talking about yield curves. Well, a yield curve simply shows us, depending upon maturity, so 1 year, 5 years, 10 years, 20 years, various maturities. And it's not uncommon. You think about, if I'm going to tie my money up for a year, I'm going to want, this rate of interest, whatever that is, X. But you want me to tie it up for 5 years? I want a little bit more than X. I want like X plus, 5. You want me to tie it up for 10 years? I'm going to need X plus 8. And 20 years, X plus 10. All right, so we usually have these upward sloping yield curves. Let's say we've got this 10-year treasury, right? So here we are 10 years on this treasury. So there's the expected yield on that treasury. What did we say it was? X plus 8? Okay. So we're buying all of these bonds, all these zeros that we're going to tear this thing apart into pieces, and we're going to sell it off to the secondary market. We're going to sell it off to other investors. So we own the treasury bond, but then we're going to sell the rights off to all the cash flows on this treasury bond to other people. So the treasury is going to pay us, and then we pay the other folks. Now, here's the beauty of this thing, is that if we're in an upward sloping yield curve world like this, which most often we are, for the reasons I just gave, is that you tie up your money for a longer period, people are going to want a little more interest, right? A little more than that 2% that we get if we just tie it up for a year. So, however, when I strip these things off, I'm stripping off a 1 year that when I buy it, I'm buying it at this yield. But when I sell it, I can sell it at that yield. In other words, if I were to sell and remember, these are zeros, so I'm selling it at a discounted rate to face. So if, let's say that X is 2%, and so the 10-year is X plus 8, so let's say its yield is 10%. So what I paid to get this thing was, I paid 90 cents on the dollar to get this thing, 10%. Give or take. I'm avoiding some of the multiplicative issues here, but you get the idea. But I'm going to sell it for 98 cents because that's that extra 2%. And like I said, it's not exactly that, but you get the idea. It's not. It's a little less than 2 cents because it's on 98 cents, not on a dollar. But forgive me that math error. So I'm making 8 cents on this thing. And then this 2-year, the yield is, X plus 1. So let's say that's 3%. Well, I still paid only 90 cents for that cash flow, but I'm going to sell it at 97 cents. So I make 7 cents. So that's why people strip these things, right? Because in an upward sloping yield curve world, which is most of the time, we're able to strip off these cash flows and make a few bucks as we do it, and provide the market with these zero coupon instruments that they're really clamoring for, with a default risk-free instrument. Anyway, enough on that. So, like I say, that's a really simple solution. Trouble is there just aren't enough of those animals around to supply the demand for them. And oh, by the way, they also typically have lower yields. Right, because they are in such demand, and they're such a clean way of handling this. If we did strips, instead of costing us $67,500, it would cost us $68,373. So we're paying an extra $817,000 as an example. You get the idea, though. So, in other words, the yield would only be 7 3/4 rather than 8%. So that's a possibility, but we've got another way of solving this, of skinning this cat, if you will. First, we want to talk a little bit about, we've talked about interest rate risk, and let's talk a little bit about price risk. It's the risk that the bond prices will decrease as rates go up and vice versa. And this arises in a dedicated portfolio when the target date is not known when the target date value of a bond is not known with certainty. Now we can bring together these two elements, the reinvestment rate risk and the price risk. When interest rates increase, we have two countervailing forces going on. Increases in rates will decrease the bond prices, but they'll increase the future value of the reinvested coupons, and vice versa. When rates decrease, they increase the bond price and they decrease the future value of the reinvested coupons. That's that. And you can think of this reinvestment rate risk as also interest rate risk. So we are going to get immunized here. Get out of the way. So immunization is when we use those two countervailing forces to exactly cancel each other out. And actually, the analogy of an immunization in the health industry is not a bad analogy, because there we're boosting the immune system. Here we're boosting the system that makes us immune to interest rate risk and price risk by sending the one to battle against the other. So then we come to what's defined as duration matching. And remember, this is just a single chapter on bonds. We could do an entire chapter just on duration matching. We could do, several weeks easily on duration matching and the pros and cons of it and so forth. But the idea is that if we have a target date of 5 years, we match that with a bond portfolio that has a duration of 5 years, not a maturity, but a duration of 5 years. If we do that, the price risk and the reinvestment rate risk cancel each other out for small changes in interest rates over that time period. Now, like I said on Tuesday, it gets much more complicated than that, and I have to monitor my duration at all times. And as rates start moving away from where I was before, I have to alter my portfolio, and I have to alter the duration of that portfolio by selling some bonds, buying other bonds. So it's kind of a constantly monitored thing, but I can still be as assured as possible, short of buying zeros, of having a sufficient amount of money in the 5 years if I do duration matching. So this just suggests that, regardless of what happens to yield, 10, 8, or 6%, that the portfolio value converges towards our 100 million at our target date of 5 years, regardless of what the yields are in the marketplace. So if yields tend to be 10%, we're getting more on the reinvestment, but the price of our bond has been depressed. But the one offsets the other. If we're down at a 6% yield, then we're getting a higher price bond, but we're getting less on the reinvested coupons. But the one, again, offsets the other. Dynamic immunization is simply the idea that, as I said earlier, duration of a portfolio is going to shift as we get closer to maturity. So even if I had very few changes in the interest rate, and theoretically I should be able to hold that portfolio because I've got a variety of different bonds in that portfolio, and their duration is shifting at different rates, the duration of that portfolio is going to shift too. And at some point, I probably have to change out some of those bonds to keep. So the duration might get, instead of 1 year from now, instead of being at 4, it might be at 4 1/4. So now I need to shift it around and bring it back to 4. Or maybe 1 year from now, instead of being at 4, it's at 3 1/4 or 3 3/4. I have to extend it out a little bit. So each year, each 6 months, maybe even on a quarterly basis, I have to alter the combinations of my bonds within the portfolio to keep hitting that same target date. 2 years from now, I really should have a duration of 3, but my portfolio might have shifted because of the composition of the bonds in it, and it might be at 2.9 years, and I really want to shift it out to 3. But that's this idea of dynamic immunization, is rebalancing on a regular basis. The frequency of that rebalance, it could be daily, but that gets awfully expensive. So again, I'm compromising here. I'm offsetting the expense of that rebalancing with the benefit that I get out of it. So if it's not shifting all that fast, then I'm okay with letting it go a quarter before I alter the composition of my portfolio. And that's pretty much it out of that chapter.